Because if you use it a lot of times, as soon as you use it, you start paying interest on all of the money that's on it. And now you will focus your ammunition on a credit card that has all of your additional debt on it until it's destroyed. Okay, so you've put it all of this, you're putting all your debt onto one credit card. All right, all your transfers of your other debt that you can onto your lowest interest rate credit card. In that case, if you can, sometimes you can't put everything on there. But the ones that you can put it on the credit cards, maybe your credit card debt's transferred all into one and focus on that one. The other ones you're paying off all of your monthly bills and getting cash back for. So you do have more than one credit card that you're using. One of them's paying your monthly bills and you're paying that one off every month. But outside of your budget, all of that additional ammunition is going to pay that second credit card with the lower interest rate to then pay off those debts. Once you've paid off credit card debts and other outstanding debts that are on that credit card, leave it open. Continue to pay on that credit card and work to pay down your mortgage. Now, and car payments. This is why the cash back cards are beneficial if, by some chances, one, there's not a limit, and most of them do have limits on how much you can spend before they stop with the credit. And once they do, then don't use it anymore if you've used up that limit, because they're not going to give you cash back on $1 million that you spend. Uh, but if that's the case, then if you can, pay off your mortgage, pay off car payments and so forth on that credit card that you're getting cash back from. Because at the end of the year, when you get that 5% cash back on all you spent, that also is going to be more ammunition to help pay down debt once a year. Once the credit card and the additional debt, not your mortgage or car payment, is paid off, focus that payment on the cash back credit card, right? Because you're going to be getting cash back. During this period, figure your monthly ammunition that will be added to your car payment. Then use the cash back credit card to make those normal purchases and additional payments onto your credit card, right? So you have your ammunition, which is your credit. In our old scenario was a $500 car payment plus the additional $385 towards your credit. You make your car payment for $885 or $825 like the last example, and then you take your income with what's part of that ammunition and you pay off that credit card at the end of the month. And you do that every month because now you're getting 5% or 1% cash back on the $800 that is on your car payment, if your car payment can be paid by credit card. Okay, on your mortgage, you pay all of your ammunition with your credit card each month. Anything you're paying down, you pay it with the credit card, then you take all that ammunition and you load it up and fire it at that credit card to pay that debt off. So really, you're using the credit card as your weapon, but the ammunition, you're recharging the credit card with your ammunition. The spending on the credit card will be earning you cash back each year, and which will be a lump sum usually at the end of the year, and that's more ammunition on the debt. And here, that's also can be a reward for you. If you're doing this, sometimes you just can't pay everything towards ammunition. That could be a lot of money for you. In that case, take that money and reward yourself. Now, on our $3,000 budget from every month of your take home and you're paying that, that would actually give you $1,800 back a year from your credit card. $1,800 could give you a nice trip, some type of reward. But I know it becomes addicting to pay down those debts. That's $1,800 you can pay down your mortgage to. So eventually you have no mortgage. But the point is, if you have to reward yourself, then do it. Don't get yourself in a position where you become burnt out on it, because this is a long process. But it's just like exercise. The more you do it, the more it becomes habit and the easier it becomes for you. All right? If your credit amount is too low to pay off all your monthly expenses, either your credit card is, pay your credit card off twice a month with each check to open additional cashback charges, or open an additional one if you need to. But be careful, some will suspend your account for a period of time to make it more than one payment a month. If this happens, you have to call to get the freeze lifted, and it becomes a big hassle. And the reason why they do this, I believe, is because they have to report it to your credit. Then they're not gaining any interest on you, so forth. But if you have to open two credit cards because your monthly payments are so high, so be it, then open two. As long as they're both cash back and as long as you don't incur debt on them that you won't pay back. And don't use the cash back incentive to say, well, I'm going to go buy myself a big screen TV because I'm going to get 5% back at the end of the year. You're defeating the whole purpose. You don't need the big screen TV because you've already canceled your cable, so you don't need it, right? Don't let yourself out of that by justifying bad behavior. If you happen to open an additional card, limit one balance out. Make sure one is paid off each month. Now, depending on what your credit is, you don't want to have any high balances over 30% at the end of the month. So therefore, you want to use half and half on each card and pay those off at the end of the month because it will eventually hurt your credit if you limit one out and then pay it off and then limit the other one out and pay it off. That'll eventually hurt your credit over time. So you want to keep those balances balanced and pay both of them off at the end of the month if you can. This can be complicated to organize. Therefore, use one card for ammunition, loaded the car payment. Therefore, your credit cards will be paid off each month. It can be complicated, but it can be very, very beneficial, and it's a way to earn extra money while you're paying down debt. So I think it's a great system if you have the credit to be able to do it. You're paying down the debt, you're getting cash back and rewards for paying your debt off. Once you've paid off your car, focus that debt into the mortgage and continue until the mortgage is paid, just like the snowball method. With the cashback rewards, you should be added to principal once a year when you receive the check. Help you pay it off faster. Or you can use it. Reward yourself. Go on a vacation. I would choose to pay the mortgage off but some people might need to take that vacation. Whatever you need to do. Just know that's extra money. That's extra ammunition. This is also going to be done by earning reward points if you cannot get cash back. These reward points then can help you to get stuff like Christmas gifts to buy, or other ways of helping you save on expenses. Or unfortunately, then you have to go on vacation because you have 4 million miles that you've acquired. So it's still a way to the way to give you benefits. Or a lot of these places have gift cards that you can purchase with your reward miles or your benefit points. That's a great way to get out of Christmas gifts. You get those reward points, you buy a bunch of gift cards, you give those gift cards away, and that's a way to save money so you don't have to buy Christmas gifts for everybody. They come free. So it's like saving in the Christmas club for Christmas without actually doing it. So let's look at some loan payoff tips. How to get these loans paid off faster. And especially a mortgage is a big one. Pay half your mortgage payment twice a month, or a quarter of your mortgage payment at least once a week to pay it down faster, if your bank allows this. And a lot of times they won't allow you to do it. A lot of mortgage companies will say, oh, no, we don't allow a biweekly payment. Well, I say what you do then is you call them up and say, you know what, I'm having a tough time paying my bills. I'm considering bankruptcy. This is just becoming so bad, I might just let the house go into foreclosure. What I need to do to control and I went to see a debt specialist. You didn't. You went through this program. But what I need to do is pay my mortgage every 2 weeks, or at least half my mortgage every 2 weeks so I can stay on track. There will be someone that will override your mortgage and allow you to do it. Okay? Whatever excuse you have to use, get it done. Okay? Bi-weekly payments on a $100,000 mortgage at 5% will save you $18,000 and 5 years off your loan, which means you're paying your loan off in 5 years sooner, 25 years instead of 30, and you're saving yourself $18,000 by just paying off every 2 weeks as opposed to once a month. Now that, to me, not doing that is criminal. Right there, $18,000. If I had a stack of $18,000 there and I said, you can have this, all you have to do is pay me every 2 weeks the mortgage, just call me up and switch it and, adjust your budget and this is yours, who wouldn't do it, right? A biweekly car loan can be paid off 5 months faster over the 5 years. 5 months and 5 years, it's a half a year right off of there on a five loan. You can do this with car payments as well. And that's easier to do because most people don't do that. So that's an easy way to negotiate and say, I have to pay it every 2 weeks because I get paid every week. I need to have it taken out of my check every week. Is there any way possible you guys can do that? Because I went and saw a credit counselor and they told me that's the only way I can control my finances, or else I've got myself so much trouble I might just lose the car and you'll have to take it back. Okay, we'll work something out with you. Make sure though that the additional payments on a mortgage, car payments and so forth, get put towards the principal, because a lot of time lenders like to play games with the additional payments due. You know, oh, well, we put this towards your escrow for your taxes, or we put this towards interest. And no, no, no. Make sure it goes towards your principal. Why would you pay extra interest? Because you have a terrible accountant that says, well, a mortgage is good, so you could write that off at the end of the year. I'm going to explain that in a minute. If that's what your accountant says, you need to get rid of your accountant because he's an idiot. And most accountants will tell you that because they are an idiot. They are idiots, and I'll explain that in a minute. Not all of them, but if that's what he's told you, you need to go get a new accountant. Okay? Now, the loan payoff itself, and here's a little chart. I'm a chart kind of person. It's easier for me to understand this. If you use a mortgage using the buy saver method, okay, as opposed to a traditional 25-year mortgage, all right, in this example shows a savings of $68,000 in interest over 6 years and 4 months in time saved by using the buy saver. As opposed to a 30-year mortgage, you're paying it off in 23 years and 8 months. Now, this is figured based on a 30-year fixed loan at 7% with a balance of $200,000. You're saving almost $70,000 by paying this off, and 23 years as opposed to 30 years. So buy saver mortgage, I believe you can look that up online. It's a company that will do it for you. All right. If you can't do it yourself, you don't want to negotiate, find that website. They'll do it for you. Remember, I said this before and I'll say it again. The borrower is the slave to the owner. If you don't understand debt, you're deemed to be in debt. But there's two types of debt. There's good debt, and these debts pay a return on their investment, like a rental property mortgage, like marginal accounts on trading firms and small business loans. And then there's bad debt, which is credit cards, luxury item loans, floating home equity loans that were used to purchase just stuff. This is bad debt. If your debt is making you money, then it's good debt. For example, your return on investment in a house, you bought a house, you're renting it out. You pay 6% interest. Your income after paying everything off is 10%. You're making an extra 4% on your money after everything is said and done. That is good debt. You have a margin account. You're trading stock. You borrow money on the stock. Okay, you purchase stock and your return on your stock was 10% and the margin you paid was 2%. You made an extra at 8%. That's considered good debt as opposed to bad debt. And you have to know the difference. Eventually, to become wealthy and to become a millionaire or whatever you want to do, you need to understand good debt and use good debt. Rich people don't use their own money. They use other people's money. But the investment they use other people's money in nets them a capital gain above what they're borrowing the money for. All right? That's the difference between good debt and bad debt. All right, so let's go through this. The first thing you're going to do is pay yourself first. We're creating this millionaire mindset. You got to pay yourself first. Save your money, okay? Once this is all over, you got to save it. Put your retirement into a retirement account, an IRA, a 401k, as much as you possibly can. Hopefully, you could put a minimum of 10 to 15% of your gross income into each check. That's just a basic rule of thumb. This will lower once your realized income. It lowers your realized income and could lower your tax rate, or it will lower your tax rate if you put